What up? What up, everybody? How we doing? We're doing good. Market's up. It's a good start to the week. We got some March Madness. We got some stocks, but forget about stocks. Forget about stocks. This is not the stock show. This is the ETF show. Yes, the show by, about, for ETFs. Again, just to recap, as I do every single time, what is the purpose of this show? Talk about ETFs. Why? Why do we care? Why do we care about ETFs? Why are ETFs the greatest thing since sliced bread? They are diversified. They're tax efficient. They have low fees. They're actively traded. And they're transparent. All those things apply usually. Obviously, not every ETF is transparent. Not every ETF is super liquid, and they're not all diversified either. But generally speaking, those are the things that make ETFs so awesome. Those 5 things: diversification, tax efficiency, low fees, they're actively traded throughout the day, and they are transparent. So that being said, what's up, Manny? Awesome. The ETF is made of stocks. That's true, Andrew. That's true. We do care about stocks, but within the context of ETFs, right? So I'm going to borrow a trick out of Neil Hamilton's book. I'm just going to throw on some tunes, and we're going to do this here. So I got a great show planned today. My guest is Eric. Let's turn that a little bit lower, shall we? My guest is Eric Balchunas. If you are in the ETF world, you know him. He is the senior ETF analyst at Bloomberg Intelligence. He, in my opinion, he's on like the Mount Rushmore of ETF influencers. There are a few people I think that know more than him. He's a great follow on Twitter at Eric Balchunas. If you don't follow him, he'll be on at around 2:20. And I got a bunch of questions prepared for Eric. He's kind of like one of my professional heroes, to be honest with you. I'm not trying to like fan out that hard, but like I think he's just like the greatest dude ever. So that being said, let's talk about. Let's start with last week. Let's just recap what happened. I'm going to pull up a chart that I always pull up of the gainers and losers from the prior week. And then I want to go to a different chart. But this is from etfdb.com. This is a screener. I have filtered out all the leverage and inverse funds. Get out of that. Get that crap out of here. We just want regular old ETFs. No leverage, no inverse, no steroids, none of that. Just regular old ETFs. What do we see? We see a lot of, not a ton of like patterns, at least in like the top gainers. First of all, this is on the first page of the screen. And you can see we're only down to 3%. There wasn't that much that was up a lot last week, which is fine. That's okay. It doesn't have to be a big winner. We went through this a little bit on Friday, the dry bulk shipping ETF. This is an ETF that invests in shipping futures. That's been like kind of the big winner of the year. We had some commodities, uranium, palladium, short oil and gas fund, which is interesting, and some like value divvy stuff, right? There's a dividend fund right there. There's a small cap fund, right? So not a ton here. Let's go to page 2 and we can kind of see. Well, that's interesting, right? Look at that, guys. TUR was on the first page of gainers last week, but just for fun. Let's look at TUR today. Down to, ouch. Oh, that really hurts. That sucks. Down 20% today. Hey man, this is par for the course. Like, this is a risk you need to know. If you are buying country specific ETFs, like TUR makes it so easy to invest in Turkey, right? If not for this, you would have to find Turkey-based companies, right? Or like buy the lira against something, right? Or whatever. The existence of a product like this makes it so easy if you want exposure to Turkey or any country, right? There's iShares and Global X have like a ton of country-specific ETFs, right? Europe, South America, all over. But the bottom line is, if you're buying a country-specific fund, your geopolitical risk is elevated, and that's happening here today. So that's a bummer for anyone that is long TUR. Back to the gainers from last week. You see Japan was up there. It's Turkey. Let's go to page 2. Let's just see what else was up last week a little bit. Home builders, we talked about a little bit last week. This BLOK, this is interesting. This one has sort of this is held up very strong compared to a lot of other like growth tech funds that have gotten hit pretty hard to varying degrees in the last month. But BLOK has held up pretty well, all things considered. So I thought that was interesting. And we're seeing a lot of Japanese ETFs that were up last week, and there's another uranium one. What about our biggest losers of the week? Let's go to first page 1. Biggest losers of the week. Yeah, I mean, again, we saw this Friday, so no real surprise if you're watching that show. A bunch of energy ETFs came off. They had run up so hard in the last few weeks, so it's not really a surprise to see this. There was some OPEC posturing last week, right? So not a real surprise to see the high flyer of the last 3-4 weeks sort of pull back in last week or so. So that was, I want to go through that for the gainers and losers of the week. I want to go to a different chart though for flows. Okay. I typically look at this same table for flows, but there's also another one that I like looking at. This is the ETF.com, guys. This is another good resource that I look at every week in terms of flows, in terms of themes, right? Not just flows across individual funds, but flows across different markets. And we'll go through that in a second. So you can see here, this is the list of the top 10 creations last week, right? So basically inflows. That's what creations means. Inflows, redemptions means outflows. Again, for those who are new to ETFs, they trade intraday like stocks, and they take in money, and money goes in and out basically all the time. Right? It's not really how do I say it? It's not so much a reflection of like the fund won't necessarily go up a lot if there's a lot of inflows, or it won't go down if there's a lot of outflows, but it's a reflection of how popular the fund or the stocks that it holds may be over a given time, and where investor attention is, right? It's similar to, I look at it kind of like volume, right? Like you look at volume, it's like, oh, okay, like this is like the most active stuff. Creations and redemptions kind of tells you, okay, like a lot of people were like piling into this thing last week. But again, because ETFs are structured in that unique way with the creation and redemption, a lot of inflows is not necessarily going to make the price of the ETF go up. It could, but it's more of an indication of eyeballs and attention. So looking at last week, these were the top 10 creations according to ETF.com. You can see here, this is interesting, a lot of dividend stuff. You don't see, there you see the QQQs. You see one like tech-centric fund at the bottom. But the rest of this stuff is all like look at dividend, mid cap, small cap. That's interesting. Same in the market. Another small cap, equal weight, right? Mid cap. So a lot of like the not sexy stuff has gotten sexy, right? You would never see a dividend like last year. I don't remember ever seeing like a dividend fund at the top of the weekly list for inflows, right? But the Qs being there again, Qs is also like a trading instrument. Although I have a theory about the QQQs that I want to ask Eric Balchunas on when he comes on in a few minutes. So that was inflows. Let's look at outflows here. So a high yield corporate bond fund, HYLB, was your leader for outflows. SPY, which again more of a trading instrument, so not necessarily indicative of that. A lot of fixed income though, right? You see that one, IEF fixed income, SHV fixed income, TIP fixed income. So a lot of fixed income ETFs near the top of the leaderboard of funds that lost the most money in terms of AUM last week. Not in terms of performance, remember, just in terms of the money that the fund is managing. Let's go zoom out a little bit and look at flows by asset class, because this is something that is also important to look at, I think, right? We're looking at ETFs. I use ETFs as like sort of my gauge for the market rather than look at a bunch of individual stocks. I can look at one ETF and see what 500 stocks are doing, more or less, right? So this is, I think, a important table to know. You can see here U.S. equity ETFs, so U.S. stock funds, a lot of inflows last week. That's a bullish sign, right? That is an unquestionably bullish sign. And actually, this year has been a pretty incredible year for U.S. equity inflows. There has been about $71 billion flown into U.S. equity inflows in the last, I think. Actually, no, that's that number right there. That's overall. That's the entire U.S. The entire ETF universe right there is $71 billion. So way more money going into ETFs than out of ETFs last week. And you can see the vast majority of that money was going into U.S. stock funds, which is a broad category, but it tells you, okay, a lot more eyeballs on U.S. stocks versus international stocks versus currency versus fixed income, right, versus other assets. So that was just for last week. What about for the year, though? Look at this. $252.5 billion of inflows into ETFs as a whole this year, and a little more than half of those are into U.S. stock funds. So again, it's not as if people are running for the hills. It's not as if anyone is, like, at least as these numbers would say, would seem to indicate, a lot of people, there's still a lot of buyer demand, right? There are a lot of buyers still in U.S. stocks. A lot of people still want to own U.S. stocks. And if anyone is out there saying, oh, we're due for a crash or whatever, I would point them to this number and say, well, a lot of people don't agree with that. So again, this table is at ETF.com. It's up there every week. And something else that I look at all the time. Something else I want to do here, we'll get to questions from the chat a little bit later in the show to the extent that you have them. Last week I went through a few resources that I use online. I went through a few websites I use, ETFDB being one of them, ETF.com being another. What I want to do this time is actually show you, for those of you on Twitter, I don't know if you all are on Twitter or not, but if you are, I put together a list called Etf Knowledge. And this is a public list. I will put the link in chat right now. This is a list of, it's not a complete list. For the moment, there's like 35 people on the list, 35 accounts on the list. And this is a link I just put in chat. That's a bunch of ETF thought leaders, experts, sources. If you I get a lot of my research from this list, from the people and the accounts on this list. So again, I just put it in chat right there. It's called ETF Knowledge, and you can just follow it, right? And you'll basically be following all the accounts on that list. Not a complete list, but a lot of the people that I follow, that I look to for my ETF knowledge, are on this list. Again, I called it ETF Knowledge. It's got experts, it's got reporters, researchers, analysts, issuer accounts like Direction and Van Eck and Roundhill. And so I just put that out there for y'all to see. I'll be adding more accounts, but like I said, for the moment, it's just 34 people, 34 accounts, and I get the vast majority of my ETF knowledge and news from these accounts. So I want to put that up there. Okay, let's do a couple of headlines, and then by the time we're done, I think it'll be time for our guests. So let me just start with this headline that was out of Blackrock this morning, which was super interesting. And that was Blackrock has lowered their fees on like a pretty sizable chunk of their ETFs to basically near zero. Okay, so they have a lineup of ETFs that manages around $7.5 billion, and they've basically changed the benchmark on those ETFs. They've changed the tickers, and they have cut the fees basically to a range, the expense ratios from a range of 0.03% to 0.06%, which basically is as close to zero as you're going to get. Why is this important? I'm going to show you this chart. This is actually from our guest. He put this on Twitter last week, Eric Balchunas. But this is a chart from Bloomberg, from Eric Balchunas, of the U.S. ETF issuer market, who has the most market share. And you can see at the top right there, that's BlackRock, right? iShares owns BlackRock. I'm sorry, BlackRock owns iShares. So that's BlackRock right there. BlackRock, Vanguard, State Street, that they own the SPDR funds, the spider funds. Those three issuers collectively make up the vast majority of the U.S. ETF market, meaning they manage nearly all of the assets that are in ETF land. Okay, so when iShares makes a change, like lowering the fees on a slate of their funds, it's notable, right? It's notable. So I wanted to mention that. As far as the actual funds themselves that are being lower, that this change is affecting, it's for the Morningstar U.S. Equity Style Box ETF. So if you are invested in one of the iShares Morningstar U.S. Equity Style Box ETFs, those ETFs are about to change. The index will change. The index that it tracks will change. The ticker will change, and the fee will change. So pay attention to that. Something else, yes, LOL lags. I agree. Twitter is so damn useful. I totally agree with that. I use Twitter for a shameful amount of my research. Couple other headlines on my radar. This is not really a headline, more of a chart that I thought was interesting. That's not it. Let's find it. Hold on. Okay. This is interesting. This is from Ben Johnson. He's also on the ETF Knowledge list that I put out there earlier. Look at this. So we're about at the end of Q1. We got like a week left in Q1, right? And ETF inflows are basically on pace to double the prior record. This is 2021. You can see the last few years there. Basically, you take all the inflows of Q1 of the last 3 years, put them together, and that gets you to this year. Again, so a lot of money flowing in to ETFs this year. That number I showed you earlier is a bit of an anomaly in that sense. So there is that chart. I also want to show you this chart. This is from a Charles Schwab survey. I want to ask Eric Balchunas about this in a minute or two when he comes on. Basically the survey found that a lot of younger investors, millennials, Gen Z, are interested in ETFs. And not just that, they're interested in actively managed ETFs. Now, I would assume that like the subtext of this is that a lot of them like ARK Invest and they like Cathie Wood. But for the last 15 years, if you've been paying attention to this industry, you've noticed, you've no doubt heard about this shift, right? It's been really, really hard for active managers to outperform. A lot of money has flown away from active funds into passive funds. That goes for ETFs and mutual funds. A lot of money is piled into these passive index-based funds. And it seems like there's a bit of a reversion, a little bit, especially with the success of ARK Invest. But there is some shift in dialogue now where people are saying, whoa, hold on. Maybe active isn't so bad, right? Maybe we do want to try and outperform. And so this survey from Charles Schwab found not only do younger investors like ETFs, but they like them mostly because they like actively managed ETFs. That was like the biggest reason that they put, according to this Charles Schwab survey. I thought that was super interesting. Okay. It's 2:21. So let me bring on my guest, Eric Balchunas. He's the senior ETF analyst at Bloomberg Intelligence. And Eric, I want to start off this conversation today just by saying I'm sorry. Okay. I grew up 5 miles from Rutgers University. It holds a soft spot in my heart, and I'm extremely sorry about last night. I know you're a fan, you're an alum, and I'm sorry.
Well, thank you for that. It's a very Eagles-esque loss. So I'm used to those kind of losses, but I'm not. I'm just used to Rutgers losing all the time to everybody by 50.
Yeah,
that's actually an easier life.
Yeah,
than the road of the Philly fan, which is to think you're going to win and then get your heart stomped out on and danced upon by the team you're rooting for. Yeah. And to see Rutgers now join that sort of club was not good. That said, at least they were in the tournament. At least I got to watch them prime time, and I got to thank them for that. So hopefully they'll be back, and maybe they'll make it to the Sweet 16.
I didn't go to Rutgers, but like it's hard not to root for them because they're like, well, we're on from the lovable losers, and so I am, all my friends are, from my hometown are all rooting for Rutgers, and it was a bummer. It was a bummer last night. Yeah. So, you got the bad news over with for the week, I guess. The rest of the week, and it can only get better from here. Let's just start with like overall. I just talked about the massive amount of inflows into US ETFs, into ETFs as a whole this year. What do you make of just the massive amount of money that is seemingly just pouring in to ETFs for this quarter?
Yeah, I mean, to me, there's two things. First, ETFs to me, they're like the MP3. They are a explosive technology. They bring fast, good, and cheap together in one place. And normally you can only get two of those three things as a consumer. But I think two things break that mold: Vietnamese restaurants and ETFs, where you can get fast, good, and cheap all at once. And that is powerful value proposition. And that's why I think they're just going to be very difficult to disrupt for many years. The other reason, I think that's good for about $2 billion a day, is the structural move. Okay. But $4 billion a day, something else is going on. What is that? I think what you have is market breadth. Normally we've had like the large cap US growth equity ETFs doing well, and maybe a section of the bond world, and they were carrying the weight. Speaking of basketball, it'd be like the three star players bringing in most of the flows. Well, this year it's rounded out. The bench players are contributing, and I mean value ETFs have had a record quarter with like 27 billion. That's ridiculous. Small caps, I think they're at like, I want to say 9 billion or something like that, which is big for them. And emerging markets, I think, are at 14 billion. So you've got these contributions from the bench players because people are not necessarily totally bailing on growth. They did for a week or two there, but they're seem to be back. At the same time, they're adding on to these lesser loved areas because they're associated with the reopening trade and the real economy. So I think you might be able to have this nice world where you could have this sort of high growth techie type stocks hold up. At least they might not be as great as they were, but at the same time, you've got the reopening trade kicking in because the actual economy is opening up. And it seems to be that's what's going on. The only loser here is fixed income. Those ETFs have not done well compared to years past, simply because the rates have been creeping up all year.
So is it just a general bullish signal then? That reflecting that there's a lot of buyer demand? Is that what that tells you?
I would say so. And the signal now is easy to say bullish. I was looking at flows in those, remember 2 weeks, about two or 3 weeks ago, it got ugly. And it's that feeling when you're like, okay, this is it. We're in trouble now. Well, when that moment hits, I look for the flows, and they held up the whole time. There was nothing really in the flows that showed me people were panicking. Especially the Vanguard Schwab crowd, that they never panic. But even the hot trading money that uses like the Qs and SPY, they weren't even panicking. It was clearly one of those sell-offs that just gets so hyped up and amplified by the media. And there was real selling, but there wasn't the outflows that we had been accustomed to seeing in typical sell-offs. So I was not surprised the market rebounded so easily. I tend to look at those flows and some volume numbers for indicators. But now that things are up, of course we can say it's bullish. But I think it was actually it was pretty bullish back then because there wasn't a lot of money leaving when it looked like, okay, we're in trouble now.
So I think maybe some of the freak out happened because a lot of people who owned maybe lower priced, high flying stocks were getting creamed, right? But the indexes were really holding up. So it wasn't a bear market or anything. It was a nothing burger on the SPY. But if you had like Fubo, for example, or I don't know, I'm just throwing one off the top of my head, you're probably getting crushed a little bit. So
yeah, I mean, it was ARK took it on the chin, no doubt. It was an ARK sell-off.
Sure.
And
but maybe you can tell us how did the ARK fund or the ARK flows hold up during that time?
They were pretty good. I mean, there was a lot of talk about how there was going to be this. The word they were using was run, like a run on a bank, and I'm like, that. First of all, that never happens in ETFs. Even in like the depths of 2008, SPY didn't lose that much of its assets. And when we have these high-flying ETFs, really grow up in assets. Example I look back to give me confidence in predicting ARK was DXJ. That was the currency hedged ETF of 2013 when that was on fire. It was like the most inflows of any ETF that year. And then that trade stopped working. It was actually it was better to go EWJ and have the currency exposure. And then when that stopped working, DXJ slowly bled assets for about 4 or 5 years. And it went back to like 1 or 2 billion. But the rush in was half the time as the flow out. In other words, people come in a lot faster than they leave time and time again when you have a craze in the ETF world.
Interesting.
So even amongst the craze, I was not worried on a run. Now, that said, the flows were even better than I thought. There was a week there where they lost $1 billion, but they've been taking in $1 billion every other day for weeks. So they had been given up like maybe a little ground, but then they kind of made it back. And there was a couple days where it was really bad and they they treaded water and then even took in money. So, and I can tell from sentiment on there that people always assume that retail investors are weak hands, they're going to run.
Yeah.
And it's just not the case. I think retail investors are much stronger and much more aware than the pros give them credit for. It's not the old days anymore. And a lot of people are into ARK for the long term. They like this trade, this vision. Now, whether they can deal with 3 years of her lagging, say, value funds, that's a different story. We'll see when that happens. But a couple days, couple weeks, I don't think ARK is in trouble. Yeah,
it seems like the assumption was people are going to just flip a switch and everyone's going to run for the exits at the same time. But
yes,
to your point, I don't know if that's necessarily how it works. Especially with a figure as loved as Kathy.
Also, my colleague Tom made this great chart. I wish I could show it to you right now, but it had the 2-week performance and then the 1 year.
Yeah.
Side by side in a way for all of the ARK funds and as well as some other theme funds. And what it showed was that the 2-week performance, they were down, say, 20, 30%. Bad. But then it showed how they're still up 70, 80, 100% in the past 12 months. The media focuses on the first part of that chart. Yep. And how much are you down from your all-time highs? And it looks awful. And I think that's where people are like, they're going to run. But I think most people actually realize that the fund's still up 100% in the past year. And yeah, it probably had to give up a little bit. It can't go up in a straight line forever. So I think the retail investors are a little more aware of this context than people give them credit for.
Wait, what about that whole theory though? I saw ARK put out like a video where I'll be honest, it was a little long. I didn't watch the whole thing, but just about the liquidity risk idea. The idea that they could get so big in a couple of smaller stocks that should the outflows ever come, they're kind of screwed, right? Do you agree with that idea, or do you not really see it?
I don't see it. I mean, okay. HYG is a junk bond ETF, right?
Yeah.
Half of the bonds in there don't even trade every day, and that's HYG. So, and you've seen it works fine. I think people on paper, they're like, wait a second, this ETF owns this much of this stock. This can't work. But remember, there's 160 stocks that ARK owns less than 1% of their shares. Okay. There's plenty of big names in there they could work out by selling first if they were hit with outflows. They don't have to, and especially being active, they can do whatever they want. They have even more liberties with what they buy and sell. That said, when there's inflows and they want to allocate it to one of these small names, I do think they'd probably move the price up a little bit, especially as it's not just their money, it's the front running money and their fans buying it. Yep. And that's probably what happened on the way down. So I agree there's probably an amplification effect on some of the smaller names that ARK owns on the way up and down. And so we've actually looked at those stocks, and it's almost like sometimes those stocks are like, typically there's, I don't know, 15 of them. They kind of act like high beta versions of ARK. So ARK's down 2%, they're down 3%. ARK's up 2%, they're up 3%. And they're just going to live in that. They're like little Mercuries around ARK's sun, and they're just going to do that dance with ARK for a while. But they're not. I just don't see any case where it somehow freezes and there's a problem. Even if one of the stocks they could not sell, like they were just stuck in it, the ETF could still trade. It would probably trade at a slight discount because the market maker could not arbitrage using that one name. So it would have to widen out the spread just a little bit, and the price would have to deviate a little further from the NAV before ARB happened.
Okay,
that's essentially what happens in a sell-off with bonds. Unless they can sell those bonds until that point where they feel like they can sell the bonds, that's where the price of the ETF will end up, and it might be lower than the NAV. That to me was the worst case scenario. What the real problem with ARK, if there is a problem, is just this is a fund that's in a lot of high growth names. And if there's a regime change where high growth just somehow people get in their head mentally that we don't even need these companies. We need like consumer staples. Like we need Walmart, dude. Like when the psychology changes and staples somehow become hot, and it has happened. That's probably the biggest vulnerability from ARK. It's just that the fund will lag for a while if people's sentiment changes towards this like world changing kind of, visionary thing. Right now, that still makes sense though, but it's possible that small value and value comes back, and what she's selling might just seem not in tune with the times for a while.
Well, like you said, it might take like several years of underperforming for that to really,
Agree. Yeah, that's my feeling. Yeah, because if ARK goes down 10% a day, 10% a day, that is when the rest of the market's tanking too. Like ARK might lose 5% here and there and the market flat, but at some point during an ARK total sell-off, that means the whole market's going down in flames,
right?
And then everybody's screwed. So
everyone's running for the exit in every fund, in every stock. It's not just right.
Correct. Well, in March, ARK was down 40%. They had a 40% drawdown from middle of February to March, and that's pretty bad. I mean, that's 40%. The market, I believe, drawdown. I want to guess maybe was it 28%. So that's probably the kind of thing you'd see, but that's in March 2020. Those are rare. And by the way, in March 2020, ARK saw mostly inflows during those days.
That's interesting.
That also gave us confidence to think they would not see the type of outflows that the quote Raiders of the Lost ARKK were hoping for. That's my name for the people who short.
That's a good one. Damn.
It is, right?
Oh,
yeah,
man.
It remind me of the guy, the guy who's always chasing Indy.
Yeah.
And he gets skin burn, and then his face burns off.
The guy with the glasses or whatever, right? That's a good one.
Yeah.
Damn.
That's maybe someday they'll catch her and they'll win this trade. I told them. I mean, I just warned them. This is because when you short, there's unlimited downside. But I can see the temptation to do it. They don't like her Tesla views at all.
Sure.
And so they think her and Elon is all like fraud and it all blow up. But problem is it just doesn't seem to ever fully blow up like they hope. So, yeah.
We're on with Eric Balchunas, senior ETF analyst at Bloomberg Intelligence. Eric, I want to ask you about a couple of recent filings. It feels like we're sort of in like this weird like amalgam of like influencers and ETFs like coming together in a weird way, right? We had the Portnoy fund with BUZZ. We talked with Jamie Wise last week, and you've got Scaramucci filing for a Bitcoin ETF last week. What do you make of that weird confluence of like influencers and ETFs? It's kind of strange.
Yeah, I guess it was bound to happen. ETF's always been a marketing type business.
Yeah,
full of marketing. I mean, there's the Vanguards and Schwabs, which are a little lighter on marketing, but there's always been a marketing element. So that was natural. And then the influencers has been a thing. And honestly, I think the Portnoy thing broke new ground. And I would see more of this, like the way they got Pomp's brother to Round Hill got Joe Pomp.
For the sports one, the MVP.
Yeah. Little brother Pomp, or older. I don't know if he's older or younger, but the brother.
I didn't be honest. I didn't realize they were related. I get his newsletter. I didn't realize they were related.
Yeah, I think he has like 4 or 5 brothers. There's many of anyway.
How many are there?
I don't know, 4. I could be wrong. I'm not. I know Pomp decently. I was on his podcast. Great, nice guy.
Yeah.
This definitely his brother. He looks like him.
Okay.
But it's so Pomp. And anyway, he gave a whole thing on this ETF. What was the ticker?
It's MVP, right? Yeah, the sports one.
Here's the thing. Portnoy, to me, was the best pitchman ever in ETFs. Not just because he's this, attention, he gets a lot of attention, but because he's in this area. This isn't like Spider when they got Elizabeth Banks to like hawk MBY.
That was weird.
That makes no sense. She doesn't know what she's. And they also got the MJ got this MMA fighter, like the 9th ranked MMA fighter to hawk MJ.
Okay.
That's fine. That's the traditional advertising approach. But to get Portnoy, who literally day trades,
right?
He's literally on social media. He gets that. It's so in his wheelhouse to promote this and to make him the index guy is smart also because it frees him up to talk about as much as he wants. He has more freedom than the ETF issuer.
Right.
And it ties him to the success of the ETF. So there's unlimited motivation for him to promote it. Every part of this move was brilliant, and I think it will redefine how they do this. And I think they'll go for more financial influencers than, say, just like celebrities from other parts of the world. If they do get a celebrity for an ETF, it's going to be somebody like Snoop Dogg for the pot ETF.
Sure.
It's somebody who's like really into the topic.
Yeah.
I don't see many more Elizabeth Banks type deals.
Yeah. We also had so I'm just going through the memory here of recent filings that there was the YOLO.
No, FOMO.
FOMO, sorry.
YOLO already exists.
Yeah, YOLO is cannabis. I knew that. FOMO, there's a cruise, right, which is like a travel. Reopening. There is
more or less cruise, airlines, and hotels.
Yeah. So I guess that's just a play on, hey, right now, I guess the only pure reopening fun would be the Jets, right? So this would be just another way to play that, I would presume.
Yeah. Everybody saw the success of Jets and was like, we need to get in on this.
Yeah.
So the Jets shocked everybody. And they say, okay, well, we'll add hotels and cruises to it too. And, it's interesting. One thing we've noticed is that, a lot of ETFs that have come out that are theme oriented.
Yep.
People kind of blew them off, gimmicky, whatever. Regardless of your thoughts, what they're really doing is stealing the thunder from legit quantitative factors. So like everybody knows momentum and growth and these things are real. Mm-hmm. Theme ETFs tend to repackage that. So a lot of theme ETFs are actually just momentum or growth stocks, right? Well, the cruise, airline, hotels is almost like repackaging value stocks. So I think that what you're going to see is more theme ETFs sort of come in and make legit quant factors into fun narratives. And they're going to steal a lot of that thunder. And I think the quant versus theme world is going to be an interesting matchup. And they're also stealing some thunder from the active folks because, again, they're turning something into instead of saying, I'm going to buy this value manager, pick the best value stocks, it's sort of like, here, you can invest in hotels, cruises, and airlines. Because at that point, you kind of know that is how to bet on value stocks in a reopening trade. So to me, theme ETFs might seem silly, but when you think about what they're doing and who they're competing with, it's pretty serious. And that's why they work. And a lot of times they're being built with only 30 or 40 stocks, which we call max pop potential. So it's built to have a major shiny object moment, like an ARC. And that's what the cruise is to me, is when that trade starts kicking in, that should double or triple the S&P over that period of time.
And they're easy to understand. If you say this fund is smart beta, the average person doesn't know what smart beta means, right? So they're just
smart beta had its run. Basically, it's basically characteristics of stocks that tend to can explain their performance, whether they have value attributes or size. Size factor is also something that themes are eating into as well. That means the small caps basically over time do better.
Eric, I got a couple more, and then we'll let you run. I want to ask you about the Qs. I noticed they were near the top or in the top 10 of inflows last week, and they are all over my TV with March Madness. My theory is there's going to be a lot of inflows in the Qs because of those ads. Do you buy or sell that idea?
That's a good question. I'll put it down to look to. The flows are T+1 for the Q, so we won't know till like Tuesday if any of it worked. I'm actually going to write that down. I didn't think to look. I Like I said, I wouldn't think when you do this kind of advertising, it's not related to the thing like March Madness. And I think there's a big gap there. Portnoy and especially buzzy kind of stocks. There's no gap there. It is the same thing. I think that gap is we won't see a ton of flows. I think more so you see flows just because of the I will check. Okay. It's very good. Thing with the Qs is unit investment trust. This is a structure of early ETFs.
Yeah.
In that structure, you don't need a board. It's more minimal structure than the new versions of ETFs. And so the Qs, SPY, and some of the sector spiders, I believe, and MDY. And that's why MDY hired banks. They had money to spend. They all have extra, I call it Brewster's Millions, because they have a line in their expenses where they have to spend the marketing fee allotted. So every year they've got, 10 to 30 million, somewhere in that ballpark, that they have to spend on advertising. Whereas in other ETFs, you don't have to do that. So the issuer only spends what they want to promote. Because, Invesco doesn't need to promote the Qs. Obviously it's doing well on its own. They'd rather promote some of these lesser known products if they could.
Right.
But they have to spend the Qs money. That's why you're going to continue to see these already successful ETFs advertise in places that might not seem like it makes sense totally.
Last one here, and this is from our chat. Somebody wants your opinions on O shares, their suite of funds, OUSA, etc., OGIG. Do you have an opinion about the O shares family of ETFs?
Yeah, I think you're good. To me, O shares is classic smart beta, where Kevin O'Leary, and if you ever seen him speak, he could sell ice to Eskimos. He did our event one time, and he just paced around the stage going, if your stock does this and you have bounced, I don't want to own you. If your stock does this, I don't want to own you. And he's walking around like a preacher, and I'm ready to write a check. I mean, this guy is really good. But I will say he's thoughtful in how he designed the index.
Yeah.
And that's the beauty of smart beta, which is why we like smart beta in general. It's taking strategies, sound strategies, and instead of just doing it on your own as an active manager with a higher cost fund, you're just making an index out of it and charging half the price. So what you're buying with O shares is O'Leary's takes on ways to analyze companies, and he knows he's pretty good. He has his own take. So I would watch some videos of O'Leary talking about the way he thinks about companies and investing. And if you like that, you're buying into his mind has been ETFized in those indexes. But they're good. One of them's really performing well. I think it's the OGIG. That's like the sort of internet giants. That was doing really well. But they're all pretty. When I read what they do, I'm like, makes sense to me. I mean, a lot of it's, I think, dividend oriented. It might not be as sexy as
he loves dividends. He loves
dividends. Yeah.
So, and a great place to start would be watching Kevin O'Leary's interview on the Raz Report from like 4 days ago. So guys,
really? There you go.
On our YouTube, Eric Balchunas is a senior ETF analyst at Bloomberg Intelligence and one of my go-tos. I'm a big fan of his podcast, Trillions. Eric, thank you so much. Always a pleasure. And I will look forward to more tweets about ETFs.
Thank you very much. Have a nice day.
Thanks a lot. All right. Eric, seriously, his research is outstanding. Guys, I cannot recommend it enough. If you don't want to follow just him, check out the list that I put out. I will put it back into chat. This is, again, my ETF knowledge list on Twitter. Putting the link in chat 1. Chat 2. There we go. Okay. It's 2:45. Let me turn my music back up a little bit. It's a little better. 2:45, guys. We got about 15 minutes left until I'm going to turn the stream over to Mitch. Let me make sure there was nothing else I had on my plate. And if not, we can just kind of hang out and do questions. Oh, this is what I wanted to cover. I've been trying to find stocks, tech ETFs, not stocks, tech ETFs that it seems to have held up relative to the rest of technology. There's a couple that I noticed here. I want to draw your attention to BLCN, NASDAQ Next Gen Economy ETF, and compare that with BLOK. Right, data sharing. It seems like these two have held up. Let me just zoom way in here. Relative to the rest of tech, and we can just compare it to the Qs just to get a feel. It does seem like, I mean, the performance is certainly there, right? These two ETFs, for whatever reason, have held up much stronger. These are both growth tech ETFs, right? Let's go to the here. Let's go look at BLCN. This is certainly a growth tech fund, but it is held up much stronger than a lot of its technology peers. Let's see what it holds. And so this is interesting, right? This is weird. So you've got some like obvious crypto plays, right? Like Canaan, Galaxy Digital, right? Square, crypto. But look at that. Look at JP Morgan Chase in there. Look at Daimler. Barclays is in there. This is a weird one. You got a nice mix. Mike Goldman Sachs. So they got a lot of banks, which on its surface wouldn't seem great. But then again, that's a big deal. 11% of the fund is Canaan, however you want to pronounce that. So this is a real interesting one here. This one caught my eye the other week. Look at this. More than a third of the fund is in the financial sector, and yet has been crushing it, right? I mean, it's probably what's the XLF up this year? It's probably destroying it. Let's compare BLCN to, what was I saying? XLF, right? Is that what we're looking at? All right, it's not crushing it by that much, but still, that's some nice outperformance. And this is like a techie ETF. It's a techie ETF with a lot of financials. Go figure. That's weird. Let's look at BLOK also. Block while we're at it. I've been eyeing this one for a hot minute. I'm not going to buy it. It's all crypto. Oh, it's all crypto. The whole thing is crypto. So no real surprise, I guess, to see that outperform. Okay. Let's do some questions from the chat. Manny Ayala, what do I think of GWAC? General rule of thumb is that there are so many ETFs. I apologize. I don't know all of them. GWAC is not even an ETF. I don't know what that is. What's GWAC? Good Works. That's a SPAC. Okay. I have no opinion on SPACs, especially SPACs that are pre-acquisition. I don't know what they have, if they've bought anyone, but I have no opinion. I am not the guy to ask that question, Manny. If you want a question about SPACs, check out SPACs Attack at 11 because I have no real opinions on that. I did see one. I saw one question earlier, and he asked about OUSA, which again is one of the O shares funds. It's like a large cap tech dividend, I believe. I believe that's what OUSA is. I forget what that question was. Let's go back. All right. Thoughts on DIV? Yeah, DIV is a super, super popular ETF. Let's go to etfdb.com. Search for DIV. Why isn't DIV showing up? I don't know why it's not showing. Let's take a look at the performance nonetheless. Get rid of the banks and just zoom out. This is so interesting to me because dividends, dividends code for value a lot of time, right? They're not always the same, but they kind of, in general, stocks that pay high dividends are also value stocks. And it was just so unsexy. Like, look at this performance. It's just so unsexy. So yeah, if you owned it all this time, you're getting paid that nice fat divvy, but the performance just hasn't been there until recently, right? Obviously, most everything is up from the bottom of last year, but even just since the fall, I mean, look at this thing. Let's just compare this to SPY. I mean, dividend value has been so out of favor. There's been a clear change for now in mindset. The question is, does this does this change stay this way? Does value become like the new thing for like several years? Does everybody want to own stocks that pay high dividends and ETFs that own stocks that pay high dividends? Or is this just like a temporary shift in the winds? We don't really know the answer to that, but yeah, I mean, if you want a dividend fund, this is as good a dividend fund as any to own. Let me see if I can search for it. I don't know why it is failing. Let's try this. Let's go to. Let's just go to the individual page, shall we? Let's go straight to the website. There's SDIV. Okay. This is the homepage for that website. Let's see if we can see what they own. Okay. Zoom in. So we got some airlines. I actually have always thought that low-key Hawaiian Airlines has takeover potential, but got some energy, Altria, and just a lot of consumer staples. So this is where. So again, nothing here really excites you, but that's not really the point. The point isn't to be exciting. The point is to get paid. So if you want to get paid, hey, this is as good an ETF to own as any. What is the yield on this thing? Do we have a yield somewhere? Not super familiar with. There we go. 5.71%. That's not bad. Every month? That's not bad. That's not bad. What's the expense rate? So 0.45%. Not low, not crazy low, but not super high. Kind of towards the low end, I would say. Probably in the middle. Invest in the 50 of the highest dividend yielding equity securities in the U.S. Yeah. If you want to get paid, you want to own stocks that have dividends, this is a great way to do that in one fell swoop. I wouldn't scare somebody away from this fund, right? It's large. It's got $630 million in assets. This is fine. This is a fine fund. I have no problem saying that this is a fine fund. Can I check APPS? Sure. Not an ETF, but what the hell? Look at that compared to the SPY. What a joke. All right, is there news on this today? So they're acquiring fiber for $600 million. Okay, I don't know what that is. God damn, this thing is a monster. Look, if your question, Milo, is where I don't know, what is your question? Is it where to get in, where to get out? I don't know what your question is. I mean, I would say if I was in this thing, I would hold the F on for dear life, okay? So my general rule of thumb, if I'm in a high flyer like this, is I put a trailing stop at like 40%. So, and I'll do that for like half my position. So what that means is if I'm in APPS, let's say just hypothetically, say I bought this thing a couple months ago. Let's just say I bought it like late January or whatever. When it was at, let's get rid of the SPY there. Okay. Let's say I bought it late January. Let's say I bought it. It was at like $40. Okay. Now it's at 90. What I would do is I would take half of my position, put a trailing stop in for 40%. So if APPS ever falls 40%, I'm getting triggered, and half my position is being sold. Okay. So I'm basically booking a profit while at the same time keeping the other half of my exposure to try and participate in more upside if there is it. And that way I sort of, I kill two birds with one stone, right? If you're afraid of selling because you don't want to miss out, and you're afraid of not selling because you're afraid you've missed out on all your profits, it's sort of a happy medium, right? You keep half and you let the other half ride. That's my rule of thumb whenever I'm in a crazy high flyer. And this is, of course, assuming that you don't want to buy and hold this for 5 years. If you bought this with the intention of holding it for 5 years, then and you've only held it for a couple months, then you need to reevaluate your risk tolerance and why you're buying things, right? That's what I would tell you, right? If you bought this for a trade, great, congratulations. Hold on for dear life. I would throw in a trailing stop somewhere. That way, so a trailing stop, for those who don't know, is as the stock goes higher, your stop order rises with it, and you can set it to a dollar amount or a percent amount. So I would set mine at 40%, and I would say, okay, my stop is going to always be 40% above the all-time high, or above the high from where my stop is placed. And so if it ever falls down to my level, I get filled on half my order. That's what I would do. I try to have rules about this stuff, right? If you don't have rules, you're kind of trading with emotion, and that gets chaotic, and you don't really know what you're doing, and it's not fun. So I try to always go into things. I don't buy anything without having some idea of a game plan for getting out, or some idea of how long I'm going to hold it for. That goes for stocks or ETFs. I know this is an ETF show, but that's just a window into like how I look at any sort of high flyer. So okay, 257, guys. I wanted to mention real fast that later on in the week we have our biotech small cap conference. This is Wednesday and Thursday. So we're going to have pre-market prep and such in the mornings, but the conference will start at 9. And from 9 to 3, we're basically going to preempt all of our programming with the small cap conference. So here is the link in chat to sign up for the conference. And again, 2-day event, a lot of public companies are going to be there, analysts, traders, people who specialize in trading these types of stocks. So we're going to preempt all of our programming for Wednesday and Thursday between 9 and 3. And then once the conference ends at 3, we'll resume with at the close and cannabis and our evening programming. So that'll be the deal for Wednesday and Thursday's slate of programming. As I mentioned at the top of the show, Jim Stocks, thank you very much. Thank you very much. As I mentioned at the top, we're going late tonight. We're going to like 8 or 9 p.m. So I would just hang out. We got a lot more to come. We got at the close. We got cannabis. We got after hours with Ryan Rosbiani. We got making bread with Ched, our new crypto show. We've got Ruel tonight. Big evening. I'm looking forward to this making bread with Ched show. We found a crypto trader, not just someone who talks about crypto, but someone who actively trades crypto for his job. And we're going to talk to him, or have him talk to us, actually, about what he trades. Yeah, Ruel, I didn't forget about you. Ruel Report. I did not forget. Ruel Report is also tonight. So we got a lot to get to on Benzinga. As for now, though, that's about it for my ETF show. I'll be frank. I don't think the next ETF show is for a week because I'm getting preempted on Wednesday. So my guest next Monday is Will Ryan. We're going to be talking about commodity ETFs with Will on Monday's show. But everyone, smash that like button, guys. I do this show for fun and also because I think ETFs are just super important. And I want you all to like them as much as I do. So I hope that this show helps at least gain an appreciation for ETFs. What I truly consider to be the greatest financial innovation of our time. I legit think ETFs are amazing. And I want you to think that as well. I want you to think that ETFs are awesome. Because they are. That's the truth. So, smash that like button. Don't do it for me. Don't do it for me. Do it for the ETFs. Do it for the ETFs. Maybe one day we'll do like an ETF ticker show. Like I'll go through my favorite tickers because there are a lot of good ones, right? You got Moo, you got YOLO, FOMO. You got some new ones that were filed recently that I thought were interesting. MVP is interesting. So maybe one day we'll do like an all ticker show. Okay. That is enough of ETF